Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in this video I'm going to share with you guys 5 dividend growth companies. When I say dividend growth companies, I'm not just saying they are just companies that just pay dividends. These are companies that have increased their dividends for the last 10, 15, 20, 30, 60 years basically in a row. And one of the good thing about dividend growth companies is the fact that we've had recessions, we had all sorts of things in the last 60 years, but some of these companies are dividend kings, and kings are companies that have increased 50 plus years. And the reason I like dividends is because you get that regular income. Right now I might not need that dividends, but I've made over closer to £6,000 in dividends over the last 4 years that I reinvested back into this portfolio. I didn't have to sell my shares. I reinvested £6,000 worth of dividends basically for the last 4 years. That £6,000 have now generated another maybe couple of £1,000s. That's basically what's going to happen over a period of time. It might not have done it already, maybe £100 or so far, but in the long run, maybe 10-15 years from now on, that will be the case. And this is why I love dividend paying companies. Okay, let me show you a couple of things. So this is basically what I always think about when I think about companies that I'm investing in. I need to know where the company is right now before I start investing in this business. Okay, so these are the cycle. This is the life cycle of a business basically. Okay, so the corporate life cycle. Stage 1, you got the startup. You've got those fresh new companies that came to the market over 2020. A lot of them IPO'd and a lot of them went to the moon, like the Zooms and all of these companies, right? Maybe Zoom was there, but there were other companies that IPO'd that year that went to the moon straight away. So you've got that companies. These are where a lot of the risk starts. We don't know where they are in terms of whether they're going to be around for quite some time. Is they going to be profitable? Because remember, a lot of these startups, they don't make money yet. Then they become a young growth company. Okay, so it's not there yet. It's basically starting to make a little bit of money. Okay, starting to maybe start losing less money, because remember, startups are still losing some money. Then they get to high growth companies. This is where basically Tesla was about 4 years ago, where it started to become it had a massive growth and it's starting to make profit. Okay, so this is starting to become profitable business. So like CrowdStrike is now getting to that stage where they become they have got some free cash flow. AMD is starting to basically make, over the last 4 or 5 years, have started making money, having a free cash flow, the net incomes, things are growing, EBITDA, things are growing the right direction. Okay, and a lot of that comes with the business now has a lot more momentum, is building, it's got brand reputation, is building up, is becoming a high growth business. Then you've got the mature growth companies. Those are your Microsoft, your Apples. Okay, so they're mature, but they're still growing. They haven't stopped. Like Broadcom, for example, they haven't stopped growing yet. They're still there. And then you've got mature stable. These are mainly your Procter & Gamble's, the consumer staples, the Coca-Colas, the Pepsis. They are right now a mature business that have been around for quite some time. And sometimes companies can stay between these two stages for a very, very long time. And what I normally tend to invest majority of my money is between these two. Mature growth companies as well as mature stable companies. Mature stable companies are your Procter & Gamble's that have paid dividends for 60 plus years. They're very, very mature, stable. They know exactly what they're doing. They basically, it's very difficult for them to grow organically, but so they buy other companies. So a new, shampoo company comes into the market. They've got this innovative basically product. All of a sudden, Procter & Gamble will just go away and buy them. Same goes for J&J and all of the other companies out there. Okay, and then that's what basically mature growth companies also tend to do. They acquire other businesses. For example, the fact that Microsoft invested, $10 billion about 2 years ago when OpenAI came up. That was a very business, wise decision to make. So they're still growing organically, okay, because they've got their cloud side of things, but at the same time they've actually acquired other businesses. Okay, and then at some point, of course, the businesses started to decline, and that's where 3M has gone through and potentially might be going through for the next few years. And I think things are changing for 3M right now, but it has started to decline. It has basically started to not make as much profit, and the stock went down quite a lot. And for that reason, because it's very difficult for them to grow unless they start spinning off, which is what they started doing, and then they become 3-4 different businesses. And GE has done it, 3M has done it, J&J has done recently. So a lot of these companies start doing spin-offs and things like that, just to kind of freshen things up, if you like. Okay, so these are what are basically invested in mainly, but of course here and there I will have one of those high growth companies just to kind of help the portfolio along. So right now I would say Salesforce is between here, so high growth and mature growth. So it's around here. It hasn't got to that Microsoft stage yet, and it has passed that stage of cloud strike sort of a thing. So I hope that kind of helps understanding the business cycle, because when you're investing in a business, you need to know, what am I buying? What do I need now? I need more mature companies, or do I need more high growth companies? And can I take a risk? And if that risk is worth it, then you just need to maybe make the risk of those young growth or startup businesses maybe 1% of your portfolio. You don't need to make that 10, 15, 20% of your portfolio, because once it declines or goes down, you're probably going to lose a lot of money. Okay, let's now have a look at the 5 companies that I said at the beginning of the video. I like to do the things that I just did because just to kind of helps you guys to understand, especially if you're new to investing. Okay, it's really important to understand the business cycles. Okay, right, so I've already said Procter & Gamble, and is one of the companies that have been around for quite some time. They have increased that dividends that they have been paying for 68 years in a row. You get basically $4 for every share of this company that you own. Basically the payout ratio is still very low. It's important. A lot of these companies, keep an eye on the payout ratio. Some of them will have if they are still a dividend growth company, the payout ratio will be slightly lower than 61%, which is what we're looking for right now. But remember, this is a huge company, over 400 billion market cap. So that's why it's hard for them organically to grow. So they acquire other businesses. The dividend safety is A-. The 5-year growth rate for the revenue about 5%, and the EPS is about 44%. Profit margin, return on equity, return on invested capital. A lot of these mature companies will have a really good profit margins, good return on equity, and good return on invested capital. $15.8 billion. Again, another sign is they have an excellent free cash flow. They must have excellent free cash flow, because a lot of that money they can reinvest into the business, because they can buy back their own shares, they can pay off any debt, they can acquire other businesses. They could do a lot with that money. So total return the last 10 years is 9%. Growth estimate next year is 4%, and they grow about 4 or 5% to at least 10%. So in between 5 and 10, or 4 and 10 if you like. EPS about 7%, 20% in premium right now. $143 per share is where the price should be. Now, the next one that we're looking at today is Merck. Merck is one of those pharmaceutical construed. They have a drug called construed, which is their main basically bread and butter. But yeah, so it's a great company. As you can see, they've been increasing that dividend for 14 years. You get 3 to basically 0.2% in terms of dividend yield right now, which is quite high. 51% in terms of the payout ratio. 8% in terms of growth of the last 5 years, which is really nice. $3.24 is what you get. B+ is what you will get basically in terms of rating wise. The 5-year growth rate for the revenue is 15%, EPS 50%, profit margin, again, that's not organic because they've acquired other businesses. Profit margin is about 19%, return on equity, return on invested capital, really good. Almost $15 billion of free cash flow. Total return the last 10 years, 8%. Growth estimate for the revenue next year is 6%. After basic for the EPS is actually 23%. 17% discounted right now. $120 per share is where they think the price should be. The next one is Visa. Every time I talk about dividend paying companies, I always talk about dividend growth companies, I always talk about Visa. Why? Because of this reason. Look at this, 15% 5-year growth rate, which is absolutely amazing. The payout ratio is very, very low. And the current dividend yield it doesn't even matter, because if you're looking at for 10 years from now, and I will show a dividend calculator to basically a calculator in a second to actually see how this company has performed over the last 20 years. So if you invested in these companies for the last basically 20 years ago, where would you be right now? So okay, and I'll show you at the end of the video. Okay, so stay tuned for that. If you haven't liked the video, by the way, already, please do so. It takes a lot of time and effort to put these videos together. I would genuinely appreciate that. As well as that, of course, you join us to the Patreon account where you get access to a lot of things, all the buys and sells that I regularly make. As you can see, it has A+ in terms of dividend safety, which is absolutely amazing. The 5-year growth rate for the revenue is basically 15%. The 5-year growth rate for the EPS is about 14%. Profit margin 50 over 50. Return on equity over, closer to 50. Return on equity over 28%. Sorry, and profit margin free cash flow right now we're looking about almost $19 billion. So that $19 billion, they can now buy back their own shares if they want to increase that dividend. Look at the payout ratio, it's only 21%. So next year they might decide, you know what, we're going to hike it another maybe 4 or 5%. They've been doing that double digits anyway, so they might do another 10% because they can, because they've got the money, right? And the interesting thing about this company right now is fairly valued, which I didn't think it would be. So $289 per share, 315. If we see a bit of a decline, it might actually become undervalued at some point. But yeah, in terms of total return the last 10 years, you would have made about 18% per year if you had this company in your portfolio. They're expecting the earnings to grow about 10%, revenue side of things. EPS about 13%, which is absolutely amazing to see. The next one is S&P Global, another company that I have in my portfolio, 156 billion market cap. This is one of the credit rating companies out there, one of the best when it comes to the data analytics and all of those things that they have. Basically, it's them and Moody's that actually kind of monopolize that world. Right now, dividend yield you get 0.72. Again, very low, but again, the payout ratio is very low. And they have increased that dividend for 51 years. So they are dividend king. And the latest increase, the 5-year growth rate, was 10%, which is absolutely amazing. Another A+ for this. The 5-year growth rate for the revenue is 16%, EPS 8%, profit margin, return equity, return invested capital, absolutely amazing. Return on invested capital is slightly lower than I would have liked. In terms of free cash flow, $5 billion. Total return the last 10 years, we're looking at about 20%. Revenue growth or estimate for next year is 6%, EPS 10%. Basically, Morningstar is saying is about 5% premium right now. So in the next few weeks, if we see a bit of a pullback, we might actually become a fair valued company. So I'll probably say 450s will become undervalued again. Final company we're going to talk about today is Union Pacific, another company that kind of monopolized the market when it comes to their own markets and so on, because it's very difficult to get, there's a higher barrier to entry when it comes to building in new tracks and so on railroads. So for that reason, that's why it has a wide economic moat, and there's not that many companies that own their own tracks. To build the tracks is going to cost a lot of money and manpower. So not many companies try to do that anyway. So you get basically 2.3 in terms of dividend yield. The payout ratio is only 48%. The 5-year growth rate 7%, and 18 years of increase in that dividend. So this one, and this one, they're heading towards the dividend aristocrat. Aristocrats are companies that have increased that dividend for basically 25 years or more. You get $5.36. A+ when it comes to dividend A rated when it comes to dividend safety. The 5-year growth rate for the revenue is 2%, EPS about 5%, profit margin, return to return invested capital decent, $5.5 billion of free cash flow. Total return the last 10 years 9%. Revenue growth is expected to grow about 4%, EPS about 11%, fairly value right now $218 per share. So 232 is where it's at. 218 is where they expect it to be in the next potentially, well, that's where the intrinsic value, basically that's what they're expecting it to be. I'm going to quickly show you the Shariah compliance side of things, and then I'm going to show you the compounding calculator to see where these companies are at. So in terms of these companies, nothing to worry about. This one is probably got higher debt right now, so interest bearing debt of 22%, so nothing huge to worry about. So what have I done? I have to basically decided if I've invested in this company in 2004 up until now, so that's 20 years, I've invested $10,000 basically dollars into this portfolio. I would reinvest the dividend that I'm receiving. Each company gets equal amount in terms of portfolio, so 20% of my entire portfolio, just the 5 companies. I wouldn't do this, by the way, in real life, but I'm just showing you what it would be like. Okay, and what would we get? So $10,000 we put into, we would have right now let's call it $125,000 right now in the portfolio after 20 years of just reinvesting. You buy the 5 companies, you just leave them alone, and you reinvest all your dividends, and that's it. but compound annual growth rate of 16% every single year. So that's basically beating the S&P 500. If you look at the last 20 years, there has been years where it was a negative, but you will still be making a good money. So worst year, you would have lost about 10%, okay, and so on. The best year, you would have been up about 42%, which is absolutely amazing. Now let's spice things up, because this is fine. But what if I decided, you know what, I'm not just gonna add that 10,000. I'm gonna dollar cost average. So let's say $500 every single month for the last 20 years. So just 500, okay, adjusted for inflation, and that's it, monthly. So every single month I'm gonna add £500 from my salary, and that's all I'm gonna do. Okay, let's backtrack this, back test, and see what it says. $686,000, and that's the power of compounding. That's the power of adding that £500 a month for 20 years. Imagine you working in a nice company, you gain, I don't know, $4,000, $5,000 every single month, and you only invested $500 a month every single month for 20 years. And 20 years, people think is actually that long. Genuinely, 20 years, it is long, but when you look back now, and I started working, I don't know, 13-14 years ago, and when I was like, oh gosh, that's been a very long time. But 20 years is not that long, okay? Even if you did it for 10 years, look at that, $686,000. If you carry on for another 5 years or so, you probably would get, because of compounding effect, keep doing the same thing. So imagine you increase that from 500 to 1,000. Oops. Okay, so $1,000 every single month for 20 years, 1.2 million. So from 680 whatever it was to right now 1.2 million, which is absolutely amazing, and that shows you the power of compounding. So the moral of the story is, dividend companies are solid businesses that have been around for a very long time, very reliable, very easy businesses to understand, of course, if you do your research and so on, and just you buy and hold and leave them alone. And that's what I'm trying to do in my portfolio. Every single company that I've talked about today, I actually do own them in this portfolio, and I will quickly show you exactly, just to be transparent. Basically, that's one. S&P Global, Visa is there. What else have I talked about? Procter & Gamble's there, Union Pacific is there, and Merck is there. So all the companies that we talked about today, I do own in my portfolio, and I plan to hold them for a very, very long time, inshallah. Right now, some of them are overvalued, some of them are undervalued. The ones that are undervalued, I'm looking at seeing maybe should I buy more of. The ones that are overvalued, I'm just going to wait and be patient, because I don't like buying them when they're very expensive. So inshallah, we'll see what happens, but that's what I'm trying to do. That's what I'm trying to convey here. And if you're trying to get into the stock market, you just have to have that mentality. You just have to think about the long-term plan. And by the way, just to let you know, the Broadcom has now crossed over £10,000 in days, basically of value, £8,224 in profit, or 445% up. This is ridiculous. I don't even know what I'm going to do with this company, but I'll let you guys know. If you're still here, I appreciate you guys. Put them basically whatever you own, whatever you're buying, whatever plans are in terms of buying dividend companies, just put it on the basic comment section, inshallah. And join us on the Patreon account, please. It takes a lot of time and effort to put these videos together. I would appreciate if you can join us, inshallah. Have a wonderful day. Assalamu Alaikum.